in even the highest rated mortgage bonds. It's the first time that's happened since the financial crisis. How much more pain could be on the way? Josh Friedman is co-CEO and co-founder of Canyon Partners. He joins me here at Post 9. It's nice to see you again.
Nice to see you too, Scott.
So this is quite topical, given some of the headlines we had last week, S-REIT and limiting redemptions and such. I mean, you've been warning about more carnage coming in this space. How concerned are we now that we see these kinds of headlines?
I think there are concerns that are shared both across the real estate spectrum and across the corporate spectrum. You've got rates that are stubbornly high and are unlikely to be reduced anytime soon. And maybe they're not likely to be hiked either, but in my opinion, they're not likely to be eased anytime soon. And you have a lot of balance sheet maturities coming up where people need to refinance in a world where rates are twice what they used to be. In real estate, it's compounded by the fact that there have been significant changes in where people live and work and how they live and work. So it's met obsolescence of certain property types on top of that interest rate issue.
These bonds in question of last week related to one specific building in New York City. So we're not trying to make a mountain of a molehill by any stretch, but are those rumblings of things that will be duplicated, or are they just idiosyncratic one-offs based on one building here and there?
I'm sure there are other buildings here and there. That one was a unique combination of almost every bad factor you could have. A somewhat obsolete building with a very, very large single tenant vacating and a lot of debt coming due at the same time and no one to replace that tenant. And the carnage was significant, with even the AAAs being significantly impaired. That may recur here and there. I think that what will recur a lot is the situation with respect to B office. We've seen that already. These problems tend not to bubble to the surface until they actually default. There's no reason for them to bubble to the surface before that point. But that's product obsolescence on top of balance sheets that were created in a world of very, very low interest rates, where people were desperate to put their money into something with a yield, and so they over-leverage these properties.
You alluded to the fact you don't see rates coming down really anytime soon. Is that saying that you don't think the Fed is going to cut rates at all this year?
I'd be surprised if they cut rates, certainly before the election. You've got a lot of factors that mitigate against them cutting rates. You've got a very strong stock market that has produced maybe $9 trillion of value to consumers in the S&P alone since the end of 2023. You've got home values which are higher, so the consumer balance sheet is strong. Unemployment is stubbornly low. We continue to have good jobs numbers. We continue to have somewhat stubborn and surprising inflation numbers. So it's not clear to me why the Fed would rush to lower rates when they want to keep that tool in their pocket. And yet, on the other hand, you have not just these real estate balance sheets that are then forced to refinance in a high interest rate world. You also have the federal government balance sheet, which is loaded with debt and has to finance in a higher interest rate world. And you have something on the order of $80 billion worth of corporate high yield bonds trading at something like a 15% yield or higher, or 70-cent price or lower. So people need to refinance. People took on a ton of leverage when the cost of leverage was low. So now we're going through the adjustment process, both in real estate and in the corporate world.